Hello and welcome to the second in our series of discussions about insolvencies in the crypto sector. My name is Sean Murphy. I lead the Fintech practice here at Norton Fulbright, and I'm joined once again by my colleagues Eric Daucher, who heads our restructuring practice in New York, and by Lee Pascoe, who's a special counsel in our restructuring practice in Australia. For those of you who watched the original episode, that discussion back in November took place shortly after FTX had filed for bankruptcy. We took the opportunity to look at the insolvencies that had taken place at that stage and what caused them. And we also looked at some of the interesting issues that were beginning to emerge in those bankruptcy proceedings. Well, a lot has happened since that original conversation. Most notably, two more major players in the crypto sector, BlockFi and Genesis, have filed for bankruptcy. So in this session, we're going to bring the discussion right up to date. Among other things, we're going to cover what has been happening in the various bankruptcy proceedings, and we'll look at some of the interesting issues that these cases are raising. And we're also going to look at some of the unusual proposals that have been made for restructuring. So, Eric, I'm going to start with you. Would you mind giving the viewers just a summary of what happened last year and perhaps focus in particular on the two most recent bankruptcy proceedings?
Sure. Thank you, Sean. It does feel almost like ancient history at this point, but I think the place to start when we're talking about recent crypto bankruptcies is with the Three Arrows liquidation, which went into liquidation in the British Virgin Islands in relatively early 2022. Shortly after that went into liquidation, dominoes started falling relatively quickly across the crypto sector. High degree of pressure on a number of major institutions that had significant exposure to Three Arrows Capital. The first two dominoes to fall, I should say, were Voyager and Celsius, and we covered these in a fair bit of detail in our last presentation, so I won't revisit them, except to say that Voyager has moved towards completion with first one sale initially to FTX. That didn't work out as well as parties might have hoped. And now there's a backup sale to Binance that looks to be going forward. The second, Celsius, is still working through its process, and we'll touch on that in a little bit more detail later. There was a brief pause, and I think parties were hopeful, optimistic maybe, that the dominoes were going to be limited really to just Celsius and Voyager. That wasn't to be the case, of course. FTX failed in November. And FTX is a massive institution, of course, and it drew huge amount of attention and had another wave of negative impact across the sector. BlockFi, which had meaningful exposure to FTX, followed shortly thereafter in late November of 22. And most recently in January of 23, Genesis, which is, you can think of it sort of like a prime broker in the crypto space, has failed. These may not be the last dominoes to fall, but that sort of brings us chronologically through where we are today. And of course, we can talk about all of these in a little bit more detail as the discussion goes ahead.
So, Lee, Eric has described a scenario with lots of dominoes, many that have tumbled already. Do you see any themes connecting these bankruptcies?
The big theme is interconnectedness, I think, is the best way to describe that. And it's an interconnectedness that we probably haven't seen before in other industries, because it's not just a jurisdictional based interconnectedness, it's actually an interconnectedness across jurisdictions, across borders, because of the nature of these businesses as borderless businesses. If I have a look at Voyager, for example, which Eric touched on, Voyager was what we can call a victim of the Three Arrows Capital collapse. Three Arrows Capital was a crypto hedge fund. Voyager was a digital currency exchange. And when Three Arrows Capital entered into Chapter 11, it had a $650 million loan to Voyager Digital, and Voyager Digital couldn't actually absorb that loan and had to enter into Chapter 11 itself. Moving along, Voyager has gone through the insolvency bankruptcy process and has been in the process of selling its assets. First, as Eric mentioned, to FTX, which wasn't successful, as we're all aware, and now to Binance. Now, the Binance relationship, everyone's heard of that name before, Binance US, Binance, has a connection to FTX. Binance was part of the FTX issues at some point in time. There was a relationship there. And things occurred, and Binance is now moving on to purchasing these debts of Voyager. The FTX issues were with respect to elevator research and its own other issues that we've heard about before. And Alameda Research is actually one of the critical creditors of Voyager and one of the people that's actually opposing the Binance sale deal. Then moving along again, we're going full circle and we're looking at the Voyager debts that are owed to FTX, according to the FTX trustees. So Voyager starts off being the actual victim of Three Arrows Capital and then ends up being the one that FTX is pursuing for recovery of its own outstanding debts. So you can see that this interconnectedness is actually quite extraordinary and something we haven't seen probably in other industries before.
So, Eric, there have been two further major bankruptcies in the wake of FTX. Let's start with the first one, BlockFi. What's happening with that bankruptcy?
So I'll be just a touch circumspect both on BlockFi and on Genesis, as we have active roles in both of them. But BlockFi is an interesting case, and it ties in very nicely with what Lee mentioned about interconnectedness, because BlockFi was quite interconnected with FTX. As we mentioned earlier, dominoes started falling some time ago in the crypto space, and pressure hit BlockFi relatively early in that process. BlockFi responded by cutting a deal with FTX. You could describe it as a bailout. It was a bridge to a potential sale transaction that was designed to help stabilize BlockFi. The result, however, is both significant inflows to BlockFi from FTX and its affiliates, and significant outflows from BlockFi back to FTX and its affiliates. As part of those transactions, there was also a pledging of shares in an entity called Robinhood, which lots of people in the space will be familiar with, which were held by, call it an FTX affiliate, although the exact relationship there is disputed, in favor of a loan extended by BlockFi to an FTX affiliate. Since the filings have occurred, those shares have actually been seized by the US federal government, which adds another layer of complexity to things. So to say that the situation is evolving rapidly would be an understatement. However, at the moment, you have what's becoming the template for these cases going forward. You have parties exploring a sale. Other options, of course, remain on the table, but we've just in the last day or so seen bidding procedures approved for a potential sale of the BlockFi assets, should buyers emerge.
Okay, and let's move to the most recent bankruptcy, Genesis. Do you have any insights on what's happening in those proceedings?
I do. Again, I'll be a touch circumspect, but Genesis is also interesting and also fits very nicely into Lee's thesis about interconnectedness. Genesis is actually interconnected both with Three Arrows, so all the way back to the beginning of the chain of events, and with FTX. I'll explain that. Genesis was a very substantial lender to Three Arrows. In fact, one of its subsidiaries extended a loan of approximately $2.4 billion in US dollar terms. So very substantial exposure. Fast forward to the FTX bankruptcy, however, and Genesis had managed to stay out of bankruptcy, managed to stay out of Chapter 11 through this point in time. It had engaged in some transactions with its affiliated entities in the meantime, but it managed to stay out of bankruptcy. FTX, the failure of FTX, I should say, however, had this cascading effect through the market, really suppressed confidence in large portions of the industry as a whole. And this created, for lack of a better term, a run on the bank that was Genesis, a massive calling of obligations, which forced Genesis to suspend transactions and start looking for solutions. It's very publicly announced that it's been engaging in ongoing negotiations around a solution with some of its major stakeholders. As of the time of its bankruptcy filing, those discussions had not yet borne fruit, and thus we end up in Chapter 11. Again, it's been announced quite publicly. Those discussions remain ongoing, with parties hopeful that a solution will be reached in the near future. If a solution isn't reached, the Genesis debtors have indicated that they intend to seek mediation. There is a status conference in that case scheduled for February 1st, which, depending on how quickly this gets on the air, may now be in the past. And so we may have additional information on exactly where those discussions have led and whether we're headed to a negotiated deal or mediation in the very near future.
So, Lee, I mentioned at the beginning that these bankruptcy proceedings are raising a whole range of interesting legal questions. One of those questions is quite a fundamental one, which is what is crypto, and is it property for the purpose of insolvency proceedings? Have any of the bankruptcy proceedings cast light on that question?
Thanks, Sean. Yes, that is the fundamental question in most of the bankruptcies in most of the jurisdictions. Recently, the Celsius Network case actually was lauded as being the latest case to determine that property question in the United States. It didn't deep dive into the property question per se, but I'm not necessarily criticising that, but rather saying it didn't need to, because where the court looked to at that point in time was the terms of use between the users of the Celsius platform and themselves. And they looked to the fact that crypto assets, or a particular class of crypto assets in that instance, were actually those of the insolvent estate. But that was pretty much done on a purely contractual basis rather than deep diving into the characteristics of cryptocurrency for a property question. That's been looked at in the context of insolvency and bankruptcy, predominantly by the UK courts, who have done a really, really good job of it and have actually proposed that there should be a third category of digital assets as digital property, so to speak. And that's really important for probably more the Commonwealth countries such as Singapore, the UK and Australia, where the property question is the touch point of all of the bankruptcy and the insolvency proceedings. Without leaving the Europeans out, the Netherlands have actually looked at the question as well in the context of a Dutch insolvency. In fact, it was some form of statutory demand. And some of the other smaller jurisdictions have also considered it. But unfortunately, the states haven't done that deep dive just yet into the characteristics of property. But then again, they may not need to because of the different legislative provisions in that regard. So in answer to the property question, yes, it has been dealt with, but it is a jurisdiction by jurisdiction proposition. So if it's necessarily property in one jurisdiction, just take a little bit of care in that going forward.
So, Eric, I've heard quite a bit of chatter about the concept of restructuring via tokenization. Have you heard similar chatter, and do you have any insights on that?
Quite a bit of chatter on that topic lately, particularly in the Celsius bankruptcy, where the debtors have indicated that's at least something they're considering. In that case, a sale process had been pursued. A number of bids came in, and the debtors have indicated that for a number of reasons, those bids were not particularly compelling. And so now there's discussion of at least a possibility of liquidating remaining assets through some sort of residual asset token. And I think, frankly, Lee can maybe speak to that in a little more detail, not with respect to Celsius, but how similar structures have been used successfully in the past.
Thanks, Eric. Yeah, there has been a similar out-of-court restructure in the instance that I'm going to talk about with Bitfinex on two occasions, actually, 2016 and 2019, where that tokenization of debt or distributions, I guess, has actually been dealt with. So how they dealt with it in Bitfinex, which was the subject of a hack on two occasions. So similarly to some of the other crypto insolvencies that we've seen, there's been a massive loss, hole in the balance sheet, can't actually meet those expectations of users. So rather than actually enter themselves into some form of Chapter 11 or insolvency proceeding, they've actually tokenized the money or the cryptocurrency owing to the creditors. How that worked was, for example, I have 100,000 that's gone missing in this hack, and I'm issued with 100,000 equivalent dollars of native tokens for, in that instance, the Bitfinex digital currency exchange. It will probably work slightly differently with the Celsius because of the nature of their business was a slightly different business. But going back to my $100,000 of native tokens, I was then entitled to trade those native tokens through the Bitfinex exchange and through any other exchange that was going to accept those. So as a creditor, I had the benefit of actually making potentially some money on those tokens or losing them, depending on where the market was sitting at any particular time. Then there was the redemption right at the end of the period, which enabled Bitfinex to get back on its feet and then required Bitfinex to buy those tokens or redeem those tokens for the dollar value, so the par value essentially. So I had some security at the end of that process, subject to, of course, the company being able to trade out of its difficulties. And that successfully worked on two occasions. The other issue with tokenizing debt is you can actually program tokens. So it's not necessarily limited to a trading ability. You can actually program to be paid dividends, for example. So I'm not sure if that's in any contemplation that there is some sort of programmable right to dividends in the company's successors if they get back on their feet. So there is quite a lot of opportunity for tokenizing debt in the right jurisdiction, because I accept that many jurisdictions won't actually accept this type of restructure, but the right jurisdictions may actually take this on board as something to look at in both out-of-court settlements and through insolvency proceedings.
Thank you, Lee, and thank you, Eric, as well. Thank you both very much for your insights. There are lots of other questions that I could have asked you, and it sounds as though the situation is evolving rapidly. So I suspect that we'll be reassembling before long with another update on the situation. In the meantime, if anybody has any questions about crypto or the bankruptcy proceedings that are taking place, please feel free to reach out to any of us. Our details are on our website. Or you could, of course, reach out to your local contacts at Norton Rose Fulbright. But for now, goodbye. Thank you.